Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. I think the question that is on everybody's minds right now is what's going to happen next after this rally. Of course, a lot of investors have been disappointed over and over again throughout 2022, expecting a broader market recovery, expecting a breakout above this downtrend, and so far that has never come. As we've seen the Fed step in repeatedly over and over again, talk the market down. That's really been their mandate throughout 2022, is to talk the market down. So has anything changed? And should we expect this rally here that we're seeing to roll over on the SP 500? And of course, the answer to that question is going to have big repercussions on the rest, on how we position in the current market environment. Now, this is a chart that I wanted to show you guys in this video. Now, this is actually a chart that I captured last week during the trading day on the S&P 500, and you can see here the put call ratio, right? This is the ratio of puts to calls in the market, the number of people who are betting on the market to go down, divided by the number of people who are betting on the market to go up. And you can see this ratio reached the same levels that we saw in November and December of 2021. So in other words, the market top. So when I saw this, I was quite concerned. So I went to take a look at the put call ratio charts in a lot more detail to try and answer the question whether or not this should be a big warning signal for the rally that we're seeing right now, and whether that's a sign of complacency in the market and that we should expect it to roll over and see the S&P 500 moving aggressively back down. And you can see just this brief context here. If you look at this example here, in June of 2020, we had an extremely low put call ratio reading that occurred right at the end of this big rally that we had following the COVID bottom. Put call ratio spikes, a lot of panic in the market that turned straight into complacency. On the 8th of June, we had that reading that marked the exact top of the market before a period of consolidation. Now, the market resumed higher because fundamentals were ultimately driving the market higher, but this was a topping signal. So that's the question we're going to address in this video. But before we get into that, make sure not to miss the Black Friday deal that we're doing. It's of course a limited offer, as you can see from this nice countdown that we put. We never do these types of discounts on our service, so make sure to take advantage of it. We have a bunch of features on the website that we've been working on throughout the past year that I think you guys are going to appreciate very much. We're constantly striving to have the highest quality research possible to be able to pick the best assets for the current macro environment, whether that's to take advantage of it or to hedge against the risks in that environment. And as we've seen throughout 2022, there are a lot of risks to take into account in the current market. So that is something that we're trying to guide investors through. And then of course the model portfolio, because it's one thing to know what the assets are, but you have to have an ideal allocation in order to be successful. And that's all provided in a concise, clear, and actionable way for you guys, so you don't have to waste time and you can cut straight to the very important points. So make sure to click on the link down below if you are interested in that. So as I was saying at the beginning of this video, the put call ratio is an extremely relevant indicator to look at if you're trying to understand what the current sentiment is in the market. Now, this is one of the big put call ratio indicators that we look at, the LOBO, and you can see that this ratio times a lot of bottoms in the market. You can see here spikes in 2015 as the market was bottoming, as we had a lot of that panic. We had a spike here telling you that investors were pessimistic and that the market was likely to head higher, which is exactly what happened. And then of course here you had the put call ratio very low, telling you there's a lot of complacency, and that was the top of the market in 2018 before a big drop here. Now of course that doesn't look very big compared to what we've had throughout 2022, but that was big at the time. And then again here in 2018 you had a complacent reading on the put call ratio at the top of the market in 2018, and you can see more recently here we've had a big spike in the put call ratio right there that actually coincided with the exact bottom of the market in October right here, and we actually reached the exact same levels that we saw in COVID here at the bottom of the COVID crash right there. Big fearful reading right here in 2022, just like we saw in COVID. Now you can see it has been turning down since then, right? So that's probably what that signal was on the other put call ratio that I'm going to show you in just a second. It has been coming down, but you can see we're definitely not in the complacent zone. We're not in full panic mode, of course. We've seen quite a nice rally off the low, but we're not in fearful mode. potentially suggesting that there is room to run, right? If there's macro conditions that are favorable just after the COVID low, well, the market just continued on rallying until there was just too much complacency, and then you needed that correction. So the market could still run here. Definitely not being complacent right now. Now, of course, this is all to take with a grain of salt. You can see here throughout 2021, even late 2020, and throughout the entire year of 2021, look at where the put call ratio was throughout that year. Very, very low. And none of those really marked any big tops because there were no big tops throughout 2021. So it doesn't always work. And you could argue that you'd see the same thing in reverse, right? That you could see a lot of fearful readings if the market continues moving down. Now, we're not of that opinion. I think the market still has quite a lot of room to run over the next few months. But if we're wrong about that, well, you can imagine this type of look, but in reverse with a lot of fearful readings, which is something you actually saw in 2008 here, right? Ever since the top of the market right here, well, you had the put call ratio just stay elevated throughout the entire bear market, and it actually dropped at the bottom. You can see here that the very bottom, this is one of those moments that's quite interesting from a market history standpoint. You can see at the very bottom, the put call ratio was low. So there was a lot of people at the very bottom of the financial crisis betting on the market to go up. The put call ratio was low, meaning there were a lot of calls relative to the number of puts. And that actually marked a low that, of course, evidently has not been revisited since then. So these ratios are very helpful, but like any indicator, you have to take it with a grain of salt. By the way, if you're so far enjoying this video, make sure to click on the like button below. It really helps our channel out. There's quite a lot of tough comments, toxic criticism online, especially in the finance community. But if you do appreciate these videos, don't hesitate to let us know. Now let's get back to this chart right here, which is the put call ratio on TradingView, right? The one that you see on TradingView from CBOE. Now this is a real screenshot, right, from last week as the market was rallying. I believe it was on CPI day or maybe the day after CPI day. And we actually did see this reading go back to the levels that we saw throughout November and December of 2021. Now, if you look at what the chart looks like now, on the daily chart of the put call ratio, you don't see that spike down. So this was an intraday reading, an intraday move down in the put call ratio as the market was rallying very, very hard, and then it just spiked back up again. Now, some people will argue the intraday reading is a concern, right? And that it does show that there is a lot of complacency in the market around inflation that's coming down, and that the Fed pivot trade is a very crowded trade right now. But I think that's a big assumption, right? And something I like to do actually is put a moving average on this put call ratio because it smoothens out the reading, right? The put call ratio can be very violent up and down, up and down. But when you put a 30-day moving average, right, to see what happened throughout the last month of put call ratio readings, well, you get a much, much smoother picture. And you can see here, if I put a horizontal line through the exact level that we reached here in October, right there at the market bottom. Let me put up the SP 500 on top of this chart, and you can see here every time the put call ratio hit that line, well, it was a market bottom right there again in 2018. That was actually just before the capitulation event right there in 2016. Right here just fell shy of that line, but it did correspond to a major bottom before one of the longest winning streaks in the market we've seen throughout recent history, again in 2016 right here, and then again in 2014 right here. Pretty big bottoms in the market have been marked by this put call ratio. Not perfect, right? For example here, and of course you have to keep in mind this is all during a bull run, so that's something to keep in mind as well. So I hope you guys enjoyed this video. If you did, don't forget to smash that like button. It really does make a big difference. So that is really appreciated. And then of course, subscribe to the channel if you haven't already. We make these videos multiple times a week, covering everything that's happening on the market. Now, in the meantime, I wish you good luck on your trading and see you next time.